Good afternoon, everyone. In today's video, we're going to zoom inside of the Nasdaq, which provided us with a unique volatility edge, which the S&P and the Dow could not do. The Nasdaq was the one market that stood out today, and I want to zoom in to show you how the morning volatility gave us some clues around what we can expect as the day progresses, and the particular setup inside of the Nasdaq that triggered. Now let's start first with understanding our morning volatility note. This is the note that we sent out to all of our Futures Volatility Box members. I'll leave a video which walks through this note in a little bit more detail so you understand exactly what all of these models mean and what all of this text means. In today's video, I'll give you a quick TLDR. The morning volatility note is the note that we send out Monday through Friday, about an hour after the market opens, and it gives you your volatility landscape. We look at 10 major futures markets, and we assess which volatility models are each one of these markets on. Now, if you're new to our channel and you don't know the 5 different volatility models we have, they're printed down here in order from least aggressive to the most conservative volatility models. A better way to see this, in my opinion, is through a line graph. I think that clicks a little bit more. And these are the same 5 models plotted out. So we have the scalper volatility box models. If price action, or a market rather, is inside of the scalper, that means we have very little volatility inside of that market, and all scalp opportunities are completely valid. On the other hand, if we're on the doomsday conservative models, that's your clear sign that, hey, there's a lot of volatility inside of this market. We need to be a little bit more cautious when we go to trade it. Now, if we zoom into our index markets today, so that's these 4 markets here, let's place each of these 4 markets on our line graph. So the S&P 500, if we start from the top, was on its doomsday conservative models. So the S&P was on this far right-hand side here where we should be a little bit more cautious. We contrast that with a market like the Russell. The Russell was on the far left-hand side on the scalper. So the Russell, out of the 4 indices, was the one that was least volatile. The Nasdaq and the Dow here were on the aggressive volatility box models. So here we're in between where the Russell and the S&P is. And if you had to splice even the Nasdaq and the Dow, it's very clear that the Dow is the one that has a little bit more volatility, given that we have an active test where we're looking at prices to see who wins here, the buyers or the sellers. Now let me move on to the charts. We'll go through these 4 markets first in that morning period so you can see why each market was on whichever volatility model that it was. And then we'll move on to the trade inside of the Nasdaq. So coming inside of our charts, I have a chart of the S&P loaded here, and I'll start with the scalper models first. We'll spend the most time here just walking through the morning volatility in the S&P, and I'll go through quicker on the remaining index markets. Now in the S&P, starting with the scalper, we can see price action as soon as the market opens. This rally takes us well outside of our scalper volatility box's clouds. We don't see the sellers coming in and defending this level like we would expect. So that's our clear sign that, hey, the buyers here have a lot of control inside of the S&P. We need to be a little bit more conservative. So the scalper is broken. We go down the line. The aggressive is next. The aggressive also gets broken. So we now know, hey, the aggressive's broken as well. We go down the line one more time. The doomsday aggressive. Do the sellers hold this level, or do the buyers take us outside of the clouds? In the case of the S&P here, we can see the buyers continue to keep bringing price action up higher. So we break outside of even the doomsday aggressive models. That takes us to the conservative. Same idea inside of the conservative. And finally, we go to the doomsday conservative models where price action's finally holding. Now let me contrast this with the Russell so you can see what the opposite side looks like. Inside of the Russell, we start with the scalper volatility box models. And here we can see price action rallies into our sign entry line. This is the place where we're now checking who wins. Do the buyers take price action up outside of the clouds? We got closer, but not quite enough. Or do the sellers come in and defend these levels, giving us a move of the same distance on the opposite side? Inside of the Russell, that was about 3.3 points. We can see here the sellers very clearly had control here when they brought price action back down. So that's the difference between the S&P and the Russell here. You can see where the sellers are actually defending the level. Same idea was in the Nasdaq as well. If I come into the Nasdaq here, we start with the scalper. Price breaks outside of the scalper. So that's our sign that, hey, we have to adapt to volatility. We come into the aggressive volatility box models. And inside of the aggressive, we breach our sign entry line. And we look to see, well, who's going to win here? Do the sellers have enough control where we can see price action gets reversed and the sellers defend this level? Or do we instead see the buyers have more control where price goes outside of the clouds first? Very clearly here, inside of the Nasdaq, the sellers have more control here, even more clear than the Russell futures market. So the Nasdaq was the one market that stood out. It was about as crystal clear as we could get. If I come into the Dow here, the Dow, we can see we didn't have that information sorted out while that note was sent, which is why we saw the monitoring. We're looking to see what happens. And we had the buyers finally break outside of the volatility box clouds with this red candle right here, which was then our sign to adapt to the new volatility, shift to the doomsday aggressive, and keep going down the line. So that's essentially the morning volatility. Now let's come back to the Nasdaq futures markets and let's walk through the exact setup that we had. Now in the Nasdaq, after we saw the aggressive models holding, we keep coming in and we're looking to see where do the buyers or the sellers now have an opportunity to defend levels. That's when price breaches our sign entry line, either sides here. If we breach the upper sign entry line, that's our sign that, hey, we may have a potential short side setup here looking to fade the trend. If we breach our long side levels on the bottom, then that's our sign that, hey, we have an opportunity to buy the dip here. Now in that next hour in the Nasdaq, we just really chopped around sideways, continuing to grind up higher. We had some of these squeeze signal arrows also plot, suggesting we expect the squeeze to fire long, along with our slingshot squeeze. But no trade setup inside of this hour. It's in the next hour, the 8 to 9 a.m. Pacific hour, the 8 to 9 a.m. Pacific hour, when we finally see some price action that takes us into our sign entry lines. Now for our fade setup, there's really two different rules that we have that price action needs to meet. Rule number one, we need price to breach our sign entry line. That happens with this green candle right here. That's our sign that, hey, we're now coming into our volatility zones that we know from early on in the morning have held. So we have additional bias for why we think these models are going to continue to hold. But we need to see the second rule being met, which is our edge signal confirmation. That's this red arrow. The red arrow tells us that now we're officially in overbought territory and we're looking for that momentum to reverse. So in today's case in the Nasdaq, we had the breach, we had the edge signal, and we had the retrace back to the sign line, which is where we're looking at an entry. In terms of our stop is outside of the volatility box clouds. This risk inside of the Nasdaq was about 21 points. Let me show you that with the trendline tool. From the sign line to the outer edge of the clouds, about 20.34, and we round up there to give it a little bit more room. So 21 points is the risk. We're looking for that same 21 points for our target, and the Nasdaq goes about 39 points before we see price action reverse. Now we fall short of our second target, which is the opposite side's gray target line, which would have been good for about 74 points inside of the Nasdaq. So if we had seen that, that would have been a really nice trade inside of the Nasdaq. We still got our T1, so still we're able to bank home some points, but that second target to me is the one that usually leads to some really, really, really nice winning trading days. Still, inside of the Nasdaq here, we had price action give us T1 before we saw a little bit of a reversal coming back up to break even and taking off the remaining contracts. So that was the trade setup inside of the Nasdaq. If I zoom out so we can see the rest of the day, the lunchtime hour, no trade there, just continued to grind between our two sides, volatility box levels. Then after the lunchtime hour, one more time we see the buyers come right back in and we breach our sign entry line. So one more time, we repeat the same two rules I just talked about. Does price breach our sign entry line? Yes. Do we see an edge signal confirmation before we go outside of the clouds? No. Price goes outside of the clouds here before we see that red arrow print. So that's our sign that, hey, the volatility is picking up inside of the Nasdaq. We need to adapt to the new volatility conditions. We switch to the doomsday aggressive models here, and we can see that those models do a much better job of containing that price action towards the 10 to 11 a.m. Pacific hour. Here one more time, we see sellers coming in and defending these levels instead of buyers coming up and taking price action outside of the clouds. With the doomsday aggressive models, in the next hour, 11 to 12 p.m. Pacific, we see a breach one more time, and we can see sellers defend this level the way we would expect. This was towards the edge of an hour, so it didn't meet our trade plan rules, but it's nice to see that these levels are holding. Adds confidence that, hey, the doomsday aggressive models are the ones that are holding and the ones we can use to fade price action. So hopefully through today's video is a little bit longer, you got a chance to see how the S&P compared to the Russell in terms of the two opposite ends of the volatility spectrum, along with the Nasdaq and the Dow. We saw the Dow's volatility early on in the morning, which was even more than the Nasdaq, even though they were both on the aggressive models. And the Nasdaq was the one model which very clearly gave us an edge off of the aggressive volatility box in that 8 to 9 a.m. Pacific hour. I hope you found this video useful. Take care, good luck trading the rest of this week, and for all Futures Volatility Box members, I'll leave links to 2 videos in the description box, one which walks you the morning volatility note, and the other, which I think is the more useful one, which walks you the process that we ourselves use to write the morning volatility note so you can repeat that process yourself. Take care, everyone. Good luck trading, and I'll see you in the next update.